Hi, this is Alessio. Hope you're well. In this video, I want to talk to you about whether I agree with analyst Bob Prechter's bearish view on the markets. So as you probably saw in my previous video, I interviewed the well-known Elliott wave analyst Bob Prechter about the long-term view for stock markets and Bitcoin. And as you saw in those videos, Bob has a very bearish view for the stock market as well as for Bitcoin. He's expecting a long-term bear market cycle to begin in the next several months or likely in 2024. So what I want to talk with you in this video is whether I agree with this bearish analysis or not. And to what extent do I agree or disagree? All right, guys, join me. All right, guys, welcome back. So before we begin talking about the major markets and also my analysis of Bob Prechter's views on the major markets, let me just mention to you where I am. I'm currently in Bournemouth, the coastal town in the south of England. As I mentioned before, is a fantastic town to come to, especially around Christmas time or winter time. So as I mentioned at the start of this video, I had a chat with the well-known analyst and Elliott wave analyst, Bob Prechter. Now, let me say at the beginning that I highly respect Bob and his work. He's by far one of the most accomplished financial writers of our time. He has written several important and best-selling books. For example, The Elliott Wave Principle, which he wrote with A.J. Frost, as well as The Socionomic Theory of Finance, which I think is his most important work. I would highly recommend get that book, by the way, and read it. So as you heard in the previous videos, Bob has a very bearish view on the stock markets, as well as for Bitcoin. Now, I should mention, in this video, I want to focus on the stock markets, not so much for Bitcoin. But as you probably know, the two are correlated. There's a positive correlation between the stock markets and Bitcoin usually. So what happens to the stock markets will likely have an impact also for Bitcoin as well. So I want to focus mainly on Bob's stock market analysis, which I think is much more important. By the way, I want to thank you so much for the great comments you left on my video. I had a lot of positive feedback, but I also noticed some people were saying that all this Elliott wave stuff was Nostradamus, you know, looking into the crystal ball to see the future. And some people were saying, oh, this is astrology or things like that. Honestly, guys, it seems to me that some people do not understand why we apply and use Elliott wave theory. So what I would like to do, if you don't mind, is just start this video with a brief, very brief introduction to Elliott wave theory and why we use it. In fact, I'm going to explain to you why Elliott wave theory has nothing to do with Nostradamus, crystal balls, or astrology. So very quickly, the key behind Elliott wave theory is simply fractals, or fractal geometry. So what are fractals? The physicist Alan Guth says in his book, The Inflationary Universe, he says, a fractal is a geometric figure in which a pattern is repeated ad infinitum on smaller and smaller scales. Actually, I think probably a better definition of a fractal is what's given by James Gleick in his book, Chaos. I'm sure you've heard of chaos theory. Well, chaos theory is also called the butterfly effect. And here's the thing, guys. In this book, Chaos, we learn that fractal systems, things which are fractals, exhibit something called self-similarity. In fact, fractals are self-similarity. In other words, fractals are simply things which look roughly the same at different scales, especially on smaller and smaller scales. It's a bit like Russian dolls. You know those Russian dolls, which I think are called matryoshkas? When you open one, there's a smaller doll inside. And when you open that one, there's another smaller doll, and so on and so on. So many decades ago, scientists found that certain things in nature, certain systems, exhibit fractal geometry, which means on smaller and smaller scales, they look similar or roughly the same as the bigger part. Okay, I'll give you an example here. Think of the branches of a tree or the leaves of a tree. So when you look at the branches of a tree, notice that they subdivide, the branches subdivide into smaller but similar versions of the bigger part. You see fractals and self-similarity also in blood vessels, in human blood vessels. You see it on the coastlines. Interestingly, the physicist Alan Guth says in his book, The Inflationary Universe, that the multiverse, the system of multiple universes, also exhibits self-similarity or fractals. Okay, let's go back to what we were talking about, fractals. So back about 100 years ago, Ralph Nelson Elliott, he found that even in financial markets, you see fractals. So what Elliott discovered was that in the financial markets, you see 5 waves move in the direction of the larger trend, but 3 waves against. And he found that this pattern repeats itself on smaller and smaller scales, again, in the financial markets. So for example, each wave, as you can see on this chart, each wave subdivides into smaller versions of itself, of the bigger part, on smaller and smaller scales. So you have waves within waves waves within waves, like Russian dolls, and similar with branches of a tree, as we discussed. So in other words, guys, fractal geometry occurs in nature, as well as in the financial markets. Now, you're probably thinking, well, why does this pattern occur in the markets in the first place? Why does this Elliott wave pattern occur in the financial markets? Well, here's the thing, guys. According to Bob Prechter and his phenomenal work in the socionomic theory of finance, human behavior and mass psychology creates waves of social mood, which leaves an imprint, leaves a signature on the markets. So when you think about it, human beings, we're emotional creatures. We're also irrational creatures. And what investors and traders do in the markets, and this could be any market, could be stock markets, Bitcoin, gold, whatever. What people do in the markets when they're buying and selling, in other words, the waves of social mood among investors and traders, from anxiety, fear, to euphoria and greed, these waves of social mood, they leave their signature. They leave their imprint, their trace in the markets. And interestingly, it follows a fractal pattern. Again, remember what we discussed about what fractals are. And that is why we see this fractal pattern, this Elliott wave pattern in the markets, as Ralph Nelson Elliott discovered. By the way, R.N. Elliott was able to use his Elliott wave theory to predict and forecast a minimum 80-year-long bull market back from the 1940s. So back in the 1940s, Elliott said, we're going to be in a bull market for at least 80 years. At the time, people thought he was crazy. People were saying to Elliott, how can he be bullish on the market when we have a war, the Second World War in our hands? But Elliott was able to use his wave patterns to forecast this minimum 80-year-long bull market back from the 1940s, which of course he was correct about. By the way, guys, one of the key reasons why I love and I use Elliott wave theory is because it's the only method of analysis out there that provides context. No other method of analysis can give us that. In fact, Bob Prechter agreed with me on this point, that it gives you context, like a big picture or map of the market. Of course, we're talking about probabilities here, but that's all you need to give you an idea of where you potentially are in the big picture, and look for turning points. A lot of people miss turning points because they're looking at the markets from a linear perspective as opposed to a non-linear, chaotic perspective, as we find in fractal patterns and also in Elliott wave theory. All right, guys, so I'm hoping in this brief introduction I managed to persuade you that Elliott wave theory is not some hocus pocus, crystal ball magic or voodoo, as some people say, like Nostradamus or astrology. No, those people have no idea what they're talking about. As I mentioned, Elliott wave theory is simply using the fractal geometry that exists in nature. By the way, this subject of fractals and social mood, which is essentially what drives the markets, reminds me of the work of the French philosopher Michel Foucault. I'm actually reading a series of works on power by Michel Foucault in this book. And Michel Foucault's ideas on power are really interesting and fascinating. And what Foucault says is that power does not necessarily work top down like what a lot of people believe. No, actually, it can work also bottom up. In fact, as Michel Foucault famously says, power is everywhere. So with the financial markets, a lot of people think that the reason why markets move in one direction or another is because there has to be some omnipotent agency like the Federal Reserve or the government to push the market in one direction or another. In other words, they think the Federal Reserve drives the market. Actually, that is not correct. As Bob Prechter has argued in his book, The Socionomic Theory of Finance, it is not the Federal Reserve that drives the market. It's the opposite. It's the other way around. It is the market that drives the Federal Reserve's decisions. Again, it is human behavior, emotions, and mass psychology that creates waves of social mood that ultimately drives the markets. More on this, by the way, in a separate video. But that also is what Michel Foucault argues on power. Power is a productive force that occurs organically within society and systems. All right, guys, now you're probably thinking, okay, Alessio, tell us about your views about Bob Prechter's analysis. As I mentioned before, guys, I respect Bob Prechter. I think he's by far one of the most knowledgeable, intelligent, and experienced analysts out there. So I do pay attention to what he says. And I would say, even if you're not into technical analysis, I would give his work quite a bit of consideration. Okay, so let's go to 3 questions one by one. Firstly, do I agree with Bob Prechter's long-term Elliott wave count going back 200 years? I would say yes, I do agree with this long-term 200-year wave count, that either we're about to complete this wave 5 of 5, this 5-wave pattern that began in the 19th century, or we have already completed it. I'll come back to this point in a few minutes. By the way, I should say that both R.N. Elliott and Charles Russell, who was a Dow theorist, both agreed with this long-term wave count. Now, question 2. Is it likely that at some point in this decade, in the next 3 to 7 7 years, we could be stuck in some kind of a long-term bear market as this chart suggests? The answer is yes. I think this is quite likely. There's a number of factors that suggest that this particular bear market cycle is going to come about at some point in this decade. If not next year, at least in the next few years. For example, if you look at the Benner cycle suggests that we could be stuck in a bear market from 2026 to about 2032. There are other economic cycles that suggest that we could be stuck in some kind of a long-term recession or depression within this decade. By the way, I'm not saying that we're going to start this long-term depressionary bear market that you're seeing here immediately. No, this could happen sometime next year, or if not next year, sometime within the next 2 or 3 years, which comes to my next point. So my final point, and probably the final question you're probably wondering in this video, is do I agree with Bob Prechter that we have topped in the wave 5 of 5 and that we're already beginning the next major bear market cycle? In other words, are we about to start the next bear market cycle, if not by the end of this year, perhaps next year in 2024? Well, this actually is much more complicated. You may recall in my previous video with Manuel Bly, I said that because the rally we saw, the very strong rally we saw in the S&P and the major stock markets, the odds changed from an immediate bear market to neutral. In other words, the odds became 50-50 because we need more confirmation, we need more information from the markets. By the way, I should say that Bob Prechter believes that we're already in a bear market. Manuel Bly and I said that we should probably wait for some kind of a confirmation like break of support or break of resistance. So here's what I think. I think if the stock market, if the S&P is able to take out the summer highs, the July highs, which on the S&P is about 4,607. If the S&P is able to take that level out and close above that July high, again at 4,607, that would increase the probability of a move towards all-time highs near the 4,818 level, if not by the end of this year, perhaps by January or February of next year. All right, guys? So we don't have that confirmation just yet. At the moment, the odds still remain about 50-50 as I'm making this video. That might have changed by the time you're watching this video, but all I'm saying is I need to wait for confirmation. Again, if the S&P is able to take out that July high at 4,607, that would significantly increase the probability of a move towards the all-time highs as long as the S&P stays above support, key support. By the way, make sure you check out the members update because I mentioned the key support level in my recent members update. But again, until we get that confirmation by taking out these summer highs, we don't yet have a high probability of a move towards all-time highs for the extended wave 5. By the way, that's probably one thing that Bob Prechter and I do differently in our analysis, which is that Bob does not use taking out of support resistance levels for a way to confirm his Elliott wave count. In other words, Bob uses form and structure of the waves to make his decisions on the Elliott wave count. Now, I respect that. There's nothing wrong with that. Me personally, because my personality is generally more cautious and I like to use confirmation, so I prefer to use taking out of support resistance levels like key levels on the charts to increase the probability of a wave count. So guys, in conclusion, I think at this moment in time, as I'm making this video, I don't think we have yet a high probability that the wave 5 of 5 has topped. So I don't know yet whether the stock market's topped or not. Because, as I've said before, we need more information from the market. Now, I know some of you are probably thinking, well, surely this rally, this big rally in the markets changed things. As I just explained, we have not yet received confirmation by taking out of resistance. So we need to wait for that. And let me say this, those of you who think that if the markets make new highs, new all-time highs, that Bob Prechter will be proved wrong in his analysis, no, that is not right. I would not jump to those kind of conclusions. You may recall, in our video interview, I asked Bob this very question about the possibility of all-time highs, and here's what he replied.
For example, in 1929, do you know there were some sectors of the market that made new all-time highs in October? Early October 1929? Most people don't know that.
So guys, as you heard there, Bob is correct. In October 1929, before the Wall Street crash, before the major crash that occurred in the stock markets that year, some key markets made new highs in a blow-off top. This is what's often called the last gasp stage, the last climax of the markets, before it suddenly rolls over. So it's possible that if the stock market, if the S&P, for example, the next several months, maybe in 2024, rallies to all-time highs and maybe goes up by 10 to 15%, that could potentially be the last gasp or the last climax of the stock market before it makes a blow-off top and then starts a major reversal or bear market sometime in the next year or two. Again, remember, the Benner cycle suggests that we could see a top potentially by 2026. Personally, I think it's going to happen before 2026, maybe in 2025, or perhaps by the end of 2024. And once the market tops, as according to the Benner cycle, by the year 2026, we could then start a major downtrend and bear market that could last all the way to 2030, 2032 in that major depression. I would say let's be cautious about jumping into conclusions videos that if the market makes new all-time highs, that therefore Bob Prechter is wrong. No, that is not the case. I think Bob is going to be proven right in his analysis. If not this year or next year, perhaps by 2025 or 2026. What we don't know yet is whether the market's topped in that wave 5 of 5 or not. And that's why I think we need more information from the market. All right, guys, hope this video has helped. Make sure you also check out my members update and my next members video as well, where I go into the stock markets, Bitcoin and gold in much more detail. Thanks very much indeed. Bye for now.